Hello students, welcome to CivicCentre IS classes. As part of daily economy series, in this class we will discuss about one of the most recent reforms that has been taken by Reserve Bank of India, especially when it comes to co-lending practices. Before we need to understand about what is these regulations all about, let's understand how banks are and other non-banking financial companies are working. In India, broadly, these banking acts were one is Reserve Bank of India Act 1934 and second one is Banking Regulation Act 1946 and another one is Payment and Settlement Act 2007 for all our domestic payments. These are the major acts that were incorporated in India, especially for the banking regulations. And at the same time, NBFCs are nothing but your shadow banking units where the banks are unable to reach their clients, especially in rural areas. These NBFCs will play a important role in financial inclusion. So the co-origination of lending, nothing but the combination of both banks and at the same time non-banking financial companies, whoever giving the loans to the borrowers, whether it should be single or it should be companies or whatever it may be. There are some certain guidelines, how much you can take from banks and how much you can take from NBFCs. What is the interest rate, whether interest rate will be fixed by RBI itself or it has the responsibility with respect to banks and NBFCs. So that is the discussion for today's class. So if you look at recent RBI regulations, RBI issued revised directions for co-lending practices, co-lending arrangements between banks and non-banking financial companies. So here we need to understand about RBI Act 1934, Banking Regulation Act 1946, and for all our domestic payments, Payment and Settlements Act 2007. So these were the major acts, right? So if you look at the co-lending is nothing but banks and at the same time NBFCs. They will give a loans. Who will take these loans? Obviously, people like you and me and companies. The banks have their own money, right? Own supply of money. Sometimes NBFCs, they will raise money through markets by issuing bonds or commercial papers, or there are different types of money instruments. So the loans which were given by both these entities, these are nothing but regulated entities. These were tightly regulated by RBI itself. The banks are regulated by RBI and NBFCs were under Companies Act. These have direct regulatory purview of RBI. So these two lending practices will be known as co-lending practices. So what are the key highlights of revised directions, especially from RBI? The first one is minimum share. So each and every co-lending partner should have a 10% minimum share in lending so that it can have a greater flexibility in loan disbursals and at the same time risk sharing. That is the first one. Second one, priority sector status. So generally RBI has revised priority sector lending targets, especially to reach the banking and especially loans to the unserved and underserved sections of the society. These priority sector lending targets will be regularly revised. If these co-lending practices will achieve priority sector lending status, then obviously they can take certificate. Priority sector certificate will be issued so that these certificates will be utilized in future, especially when they want any loans, when they want to raise money from markets, then obviously it will be a good gesture. If these companies, especially these banks and another NBFCs are getting these type of certificates, that will be given. Next one, uniform asset classification system. Let's suppose if you are giving loans, after 90 days, you did not get any principal amount and at the same time interest component on your loans. Then obviously, you will mention as a special mention accounts. Later, it will be considered as your NPAs, non-performing assets. Obviously, if bank has to decide these accounts were categorized as special mention accounts or NPAs, then obviously another co-lending partner, in this case NBFC, will also have to mention these so that the risk across these credit lines will be easily identified at early stages. So that is the uniform classification system, nothing but the classification of different types of NPAs. Blended interest rate. The interest rate components generally will be decided by banks itself. In earlier cases, it was decided by RBI. So here, what was the percentage of banks and NBFCs loan? Based on this, the internal lending calculation will be done so that the blending of interest rate will be done. So here it is very competitive in nature, so that the general public and at the same time companies will get loans at a affordable price because of these models. So what is the significance of co-lending? Obviously, for banks, they will deeply penetrated into sectors where earlier the banks were unable to reach, because of NBFCs have more reach than banks. So by merging co-lending practices, obviously banks have a wider reach to enroll different types of loans into the banking sector. Next one, for NBFCs, obviously sometimes people are very believing that these NBFCs are not regulated, are tightly regulated. Obviously, if you have a co-lending practices with banks, especially different types of banks, then obviously the trust on these co-lending practices will be gradually increased and loans will be deeply penetrated into the under section. For consumers, obviously for consumers, there is a blended interest, right? So it has to be decided by both banks and NBFCs. So in the initial days, what they will do, they will simply make your interest rate component is very less, so that more and more people will take loans. So the purchasing power with the public will be very high, because the money supply or credit availability in the economy will be very high. So the purchasing power will be very high. So it will lead to economic growth. And at the same time, you all know, economic growth is always coupled with inflation. So there is a risk of inflation also. So that is the discussion for co-lending practices. Co-lending practices are nothing but the origination of loans between banks and another NBFCs. And one more important thing about this co-lending requirements or co-lending regulations is, it is not applicable to all banks. There are some exclusions. The exclusions will be your regional rural banks, local area banks, and small financial banks. So do mention in comment section, recent times RBI has given in principle approval to one of the small financial bank to universal banks. So if you know the answer, please do mention in the comment section. What was that bank? So that is the discussion for this class regarding the co-origination lending practices by RBI. Thank you for watching class. Have a nice day.